What's up, everybody? Welcome back to Trizzy Trades, where I take you along my journey through this trading thing, showing you my wins, my losses, my pains, my joys. Today we're going to talk about what is a put option. Later on, I'm going to show you a trade that I did a put option on, as well as show you what my portfolio is looking like. A put option is actually easier for me to understand and explain than a call option is, even though I make more call options than I do put options. Maybe because the analogy of a put option makes it a little bit more clear. Well, at least to me. Now, I explain what a call option is. It is a contract for the right but not the obligation to buy 100 shares of a stock. A put option is a contract for the right but not the obligation to sell 100 shares of a stock. You can look at a put option as a form of stock insurance. Let me explain how. When you buy insurance on a car, you now have a form of protection for the car you just bought. So if something bad happens to your car, like an accident or a break-in, your insurance policy can save you from taking on a huge repair bill. Now, of course, you have to pay a premium for this policy, and this policy expires after a certain amount of time. But the premium is worth it if something bad happens to your car. That's the same thing with stocks. Say you own 100 shares of a stock at $50 per share. Then the stock tanks to $35 a share. That means at that moment you are $1,500 in the hole. However, let's say you bought a put option for that same stock with a strike price of $50 before the stock tanked like that. That means even though the stock price dropped to $35 per share, you still have the right to sell those 100 shares for $50. So you didn't have to take a hit at all. Just like an insurance policy, you still got to pay a premium for that option. Just like buying a call option is a bullish move, meaning you want the stock to go up, buying a put option is a bearish move, meaning that you want the stock to go down. Now, you don't have to own 100 shares of a particular stock to buy an option on it. If you are bearish on a stock, the real money is buying a put option on the stock instead of shorting it. Well, think about it. If a stock is trading at $35 a share, but you own a put option with a $50 strike price, that means you own the right to sell that $35 stock for $50. You can imagine a contract like that would be pretty valuable. Let me try to make it more clear with a stock I recently bought a put option on. CVS, ticker symbol CVS. Now, you all know and have been to CVS before. You probably don't know it's not just a place where you pick up prescriptions and buy gummy bears. They actually provide other healthcare services such as insurance, primary care, and even medical clinics. 2023 wasn't so kind to CVS. It took a 38% dive between December of 2022 and August of 2023. It has since been trying to creep back up, but ran into resistance at the 382 Fibonacci retracement. Took a little dip and has been trading sideways ever since. Dropping down to the daily time frame, CVS put a sharp move upward at the end of December. This was the move you saw on the weekly that hit resistance at the 382 Fibonacci. What I have learned over the years is seeing a row of candles that have long upper wicks suggest a lot of selling pressure and a probability of moving back downward. So I wanted to get a little piece of that move. Now, I could be going against the trend, so I should not expect to get 100% from this trade. Actually, I'm not going to put a lot of money in this trade either. Fast forward to how the trade is doing now, CVS has formed a pennant pattern that could break to the upside. If it breaks out, I'm out of the trade. I have no problem taking a small loss. Now let me look at the fundamentals of a company and see if there's something telling me I should not go short. Because after all, CVS did make a big push upward. I mean, who's to say another sharp move upward is not coming? Looking at the balance sheet, they do have $249 billion in assets. However, 35% of those assets are in goodwill. Now, for those who do not know what goodwill means on the balance sheet, it is the amount of money that a company overpays for an acquisition or acquisitions. Also, goodwill is an intangible asset. I mean, it's not like you can go to the bank and withdraw some goodwill. It just don't work like that. So if I excluded goodwill, CVS would only have $158 billion in total assets, while your total liabilities is $173 billion. This speaks to the financial health of CVS itself. Its current ratio is already below 1, and excluding goodwill also makes the total ratio below 1. Yeah, the current debt is only around $3 billion, which can easily be covered by the cash that is on hand, but it's rocking $58 billion in long-term debt. From the balance sheet alone, I would already put this in the no pile in terms of investment. but that doesn't mean I can't trade it. On the income statement, you see a record high revenue and record high net income year over year, while they have been buying back shares. So it's evident that while CVS's balance sheet sucks, profit is still rolling in. The cash flow statement is not bad either. Yes, it's good to see record high net income, but net income doesn't always tell the whole story, which is why it's important to look at the free cash flow. And for the record, free cash flow is just operating cash flow minus capital expenditures, or CapEx. CapEx usually shows up on the cash flow statement as purchases of property and equipment. Now, you won't find free cash flow on a company's cash flow statement, so we got to do the math ourselves. Operating cash flow for 2023 was $13.426 billion. CapEx was $3.031 billion. That gives us a free cash flow of $10.395 billion. Now, CVS did carry $15.7 billion in free cash flow 2 years ago, while 2023 ended up being $10 billion in free cash flow. But remember, they've been buying back shares and increasing the dividend. That can be part of a plausible explanation for why free cash flow has decreased so much. What they need to do is take some of that free cash flow and pay off some of that debt. So from a quick eyeball test, CVS is still very profitable and producing a lot of cash. They got to fix that balance sheet though. But there's no indications that this is a failing company. This is a put that I have to be very careful with. Turns out, I was not careful enough with this trade. At one point, I was up around 35%, but then I saw a pennant break to the upside, and I immediately got out for a $10 loss. Here's what my portfolio looks like now. I've entered some new trades. Some of them are moving well, some are not. What I do want to point out is, remember how Pfizer was down negative 40%? I'm only down 17% now, and I have till January of next year for this thing to move. That's why I give my trades a lot of time to move. They're going to fluctuate, but over time I usually reach my goal. Well, at least my first goal, which is 100%. After that, I just sell some contracts and let the rest run. That's what I did with Palantir. I just sold the last contract for like 213% profit. It had until September to move, but it did what I needed it to do quickly. Sometimes that happens. Other times you gotta wait a couple months. But the idea is to reach my goal eventually. You can also check out my trade log for the year. So far I've done 25 trades and made a profit of over $4,000. I'd like to think I'm doing pretty well. Hopefully I can keep this profit curve moving up and to the right. Stay tuned as I continue to show the progress of my portfolio. If you like the content, hit the like button, comment if you can, subscribe if you will. I'll see you next time.